Okay, let me paint you a picture. This comes from the legendary investor Benjamin Graham. Imagine you have a business partner, and every single day, this guy comes to you with an offer. Some days, he's just on top of the world, totally euphoric, and he'll offer to buy your share of the business for a frankly absurd price. But other days, he's in complete despair, and he's begging you to take his share for almost nothing.
So, who is this guy, this incredibly unstable partner? Well, here's the crazy part. If you've ever bought a single stock, you've already met him. In fact, you deal with him every single day the market is open. It's time for you to formally meet Mr. Market. And understanding this one single character is going to completely change how you see investing. And believe it or not, it's the secret to actually learning how to love a stock market crash. So, who is he really? Mr. Market is Graham's genius personification of the stock market itself. He's not some rational being calculating things on a spreadsheet. No, he is the sum of everyone's emotions. All the hope, all the fear, all the greed, all the panic, all rolled into one manic depressive business partner. His prices aren't logic, they're just mood swings. And his moods swing between two wild extremes. On one side, you've got euphoric Mr. Market. Think about the dot-com bubble, when he was slapping insane price tags on companies that didn't even have profits. And on the other side, you've got despairing Mr. Market. Think of the 2008 crash, when he was practically giving away shares in incredible, solid companies for pennies on the dollar. And this perfectly illustrates one of Graham's most famous quotes. In the short run, the market is just a popularity contest, a voting machine. It's all about emotion and what's hot right now. But in the long run, all that noise fades away, and it becomes a weighing machine, reflecting the true, fundamental worth of a business. Okay, so that's all great in theory, but if Mr. Market's prices are just based on his mood for the day, how on earth do you know if he's offering you a great deal or a total ripoff? How do you get an edge? Well, here is your secret weapon. It's called intrinsic value. This is the real, objective worth of a company, completely separate from Mr. Market's daily drama. You figure it out by looking at the actual facts, the assets, the earnings, the cash flow. It's your anchor of reality in his ocean of emotion. So let's really drill this down because it's the most important part. The price you see on the screen, that's just a feeling. It's what Mr. Market feels at that particular second. It's pure emotion. Value, on the other hand, is the real deal. It's what the business is actually fundamentally worth. Your job as an investor is to know that these two things are almost never the same. And this chart, this visualizes the entire game. You've got that jagged, crazy line. That's Mr. Market's mood, the price all over the place. But underneath it, you have that steady, stable line. That's the business reality, its intrinsic value. Now, see that gap? The area where his price plummets way below the real value? That is your golden ticket. That's the opportunity. So, what's the one rule you have to live by when you're dealing with this guy? It's simple. You treat his prices as bits of information, not as marching orders. You don't have to do anything. You are in complete control. You can just ignore him if you want. All right, let's see how this actually works in the real world. We're going to look at two huge historical moments where Mr. Market completely lost his mind, creating chaos for most people, but an incredible opportunity for a few. First up, the dot-com bubble. Back in 1999, Mr. Market was just beyond euphoric. He was convinced any company with a .com after its name was the next big thing, even if it had zero revenue. People who took his instructions bought at the very top. And then, in 2000, his mood flipped and crash. Now, for the exact opposite scenario, let's talk about the 2008 financial crisis. This wasn't euphoria. This was Mr. Market in a state of absolute, gut-wrenching panic. And the scale of that panic was just staggering. From the peak in 2007 down to the bottom in 2009, Mr. Market was in a total freefall. Convinced the world was ending, and he was slashing prices on everything. I mean, he was offering up shares in some of the best, most dominant companies in the world at 50, 60, even 70% discounts. He was terrified, and he just wanted out at any price. So what did the smartest investors do? They saw his panic for what it was, a once-in-a-generation bargain. Right in the middle of the chaos, in October 2008, Warren Buffett wrote an article saying, plain and simple, I've been buying American stocks. He used Mr. Market's fear to his advantage. And that is the absolute core of this whole thing. His fear is your opportunity. When he is freaking out, He is offering you the sale of a lifetime. Because here's the thing you have to burn into your brain. Mr. Market's moods, good or bad, are always temporary. But the value of a great business, that endures. Patience lets you just wait for the weighing machine to prove the voting machine wrong. So it all just boils down to this incredibly simple, two-step golden rule. When Mr. Market is fearful, when the news is terrible and prices are tanking, that's when you buy. And when he's greedy, when everyone is euphoric and prices are soaring, you just wait.
Once you truly, deeply understand this, your entire viewpoint just flips. A market crash is no longer this scary thing to be avoided. You start to see it for what it really is. It's a Black Friday sale on financial assets.
So I'll just leave you with this question. The next time Mr. Market has a total meltdown, and trust me, he will, are you going to see it as a threat, or are you going to see it for what it is, the single greatest opportunity he could ever offer you?